Welcome back to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers, co-host Ian Horowitz from Equity Warehouse. We're both tuning in from almost 0-degree weather here in the Mid-Atlantic on the East Coast. Not all that much fun, but I got to say I'm kind of like getting used to how cold it is, and it's certainly not fun, but it's just kind of where it's at. Looking forward to that move at some point somewhere south. If this is your first time tuning in, welcome. Promise we'll keep this entertaining, and we always like to bring on good guests that are actually doing real estate deals. So I'm sure you're going to learn something as well if you're a return viewer, follower, listener, watcher. Thanks again for all the support. We certainly couldn't do it without you. We've turned this Real Estate Reserve podcast into a great podcast, and very humble that we've had a lot of very good viewers and followers, and we're able to bring on great guests to continue to grow the show.
Yeah, you say you're trying to run south, but my boots on the ground down in Louisiana sent me a picture of 8 inches of snow in southern Louisiana. So I don't know that it's any better. Spoke to a guy yesterday in Florida. He's like, oh, well, it is 60 degrees here. But I'm like, yeah, dude, I'd rather be there. But enough about us. It is cold. It is the winter. Expect it. It happens. It is what it is. Just means golf will be that much better this spring. Guys, as Jason said, we do this show with real people that are doing real deals. We don't bring in gurus. We bring in people that actually have their boots on the ground and doing the block and tackle type stuff. So the best compliment we can give our guest is sharing the show. We don't care about the likes or the subscribes. We care about getting this show shared, help our guests out who are taking time out of their day to come and speak with us and have these fun conversations around business. And I think everybody will enjoy today's show. So I'm not even going to ruin it. Let's bring in Tom from Eagle Capital Investments. What's up, Tom? How you doing, brother?
Yo, Ian, Jason, what's up, guys? Great to be with you and all the listeners today. Looking forward to a great conversation.
Yeah, well, I mean, you're sharing this wonderful weather with us.
Yeah.
You're not too far away from
That's
me right now, and it is what it is. But I guess let's hop right into it. What I know we talked about some fun topics that we're gonna bring up here in a minute, but like,
Sure.
What got you involved in real estate? Like, how did you make the jump into real estate?
Sure, yeah. So I was a corporate guy after business school. I got an MBA, finance and accounting. So I'm kind of a numbers nerd by training, and use that to get into corporate world where I was a financial analyst. I was doing mergers and acquisitions in the aerospace industry, which was amazing. Worked with some just really incredible people, ex-fighter pilots, ex-astronauts, big ranking Air Force officers. And so we'd routinely have, 7 a.m., suit and tie meetings back then, but it was just a great environment. It's, when you're surrounded by people like that, you just can't help but sort of, lift yourself up. In fact, my one boss was he was a Gold Glove boxer at the Naval Academy, and then went to Wharton for his MBA after he did his 4 years as a Marine. So, it's just being surrounded with those people was really cool. And so, fast forward, that allowed me to kind of build a great financial foundation and, doing deals and, raising capital. And of course, there were a lot of zeros on those deals. Like I think our biggest deal, it was like 200 million or something. So, fast forward to 2006, I actually got fired from my corporate job after, moving around a little bit and continuing to do things in the financial world, continuing to do deals, public companies, all that type stuff. But I got fired in 2006. I was like, all right, this is the sign that I've needed, because I've been wanting to do something on my own. And that was the kick in the pants I needed to just be like, all right, let's go do this. And so I'd been wanting to do real estate for a while. I guess it skips a generation. My parents didn't really do anything in real estate, but my grandparents did. And so I don't know, I guess I just sort of had that DNA and, just saw that, people were, building these big portfolios of real estate and, building their wealth and cash flow and all that cool stuff. And so, of course, my timing wasn't great, guys. As you guys, I think you were back battling in that time frame as well. 06, 07, 08. Here I am. I have this great background, education. I had a war chest of money. I was like, let's go. And it was just like everything got torched. Everything caught on fire. And just lost a bunch of money those next few years. But that was the kind of the real training that I needed to then kind of launched me. So here I am, still standing, 19 years later. So
even losses or
that's
wins.
how I got started. And that was
even loss.
Go
ahead.
I was just going to say, and I the way I did start was doing wholesaling, fix and flips, residential rental properties, and that sort of thing. So.
Yeah, I mean, even a loss is a win. I mean, that's I'll never forget when I started. Anytime I had a deal that was kind of like a deal that maybe lost a little bit of money, or maybe a deal that I was like, man, I worked hard into this deal. I always kind of equated that to I just got a college education on how to flip a house, or how to wholesale a house, or how to invest in a deal. And that's what I would just tell myself every time.
Yep.
And I vividly remember that to a T.
Yeah,
because
totally.
I was like, hey, let's look at the bright side of this. I was
Yep.
listening. I think it was damn, what book was that? I don't know. I was just finishing a book, and I remember that like everything can be looked at as a win, and I think that's an important lesson. When you originally started or wanted to get into real estate, did you always kind of have the plan of wholesaling, investment, residential real estate, or did you ever kind of look above and beyond that of like, I want to develop a commercial asset or big multifamily building, or were you kind of always like, because me personally, I was always in the, hey, I'm going to flip residential houses. That was the only thing that I could like wrap around my head.
Sure. Yeah. At the time I was thinking, single families, maybe duplexes, maybe go crazy, get like a quadplex or something. But yeah, that's about the extent of my thinking back then. And certainly, as you continue to, surround yourself with good people. So I was going to the local real estate networking events. You guys might have been to like the Ring meetings down on McDade Boulevard, and go to the other, Dig, of course, and then the other subgroups and all that. So I went to those, and so it was through that process that I did kind of open up my mind to some other asset classes, maybe thinking a little bit bigger.
Yeah, I would say it's so hard to like early on. It's just like, I got to do one house, right? And then you do one house, and then next it's like drugs, and you're trying every drug known to man. You're like, I can do this, I can do that. I think I might have bumped into you early on when you were doing some defaulted mortgages.
That's right.
Just me being the little guy in the room trying to figure out life. I think you were well on your way. Like, how do you bounce? I mean, how was your experience with your first initial single family, and then how did you kind of transition through to your next phase or evolution of your company?
Well, my first deal I bought was up in North Philly. This house literally had like no roof. And I'm going in there with my calculator, figuring out, my repair costs and everything, looking at my comps, doing the whole thing. I'm going through the whole process, and I'm there with the seller. And funny little side story. I'm with the seller of a North Philly row home, right? We're in the basement. And the basement's, it's like full of water. I'm like, no problem. There's cobwebs everywhere, and it's just me and him, right?
Yeah.
Here I am, a preppy white kid from the suburbs, right? I'm in this basement with this guy, and he chooses at that moment. We're in the basement. There's nobody can see me, hear me. And he chooses at that moment to tell me he just got out of prison. I'm like, because he's explaining to me why the house is in this disrepair. He's like, I was away for a while.
Yeah.
Like, jeez. Yeah. So anyway, I survived. He was actually a really nice guy. So we got the deal done. I way overpaid for it. I tried to wholesale it. I tried to wholetail it. I tried to do, I finally got the roof fixed. Anyway, so I ended up losing, I bought it for like $43,000 or something, which I was like, oh man, this is so cheap. I probably should have bought it for $5. So anyway, lost a bunch of money on that first deal. But, I was in the game. I was out there doing it. And, you just sort of learn, you take your lumps. But it was through that process again going to the investor meetings that I did learn about distressed mortgages, which, that was the shift that I made after getting creamed in the residential world. So, we can certainly talk more about that, but that business still exists today. It's U.S. Mortgage Resolution. Joe Downs and I started it back in 2010. And we've generated, going on $59 million of revenue in that business over this time period. So, which has been pretty great. And it's allowed us to do some other things, get involved in some other asset classes, make some other mistakes, have some other wins here and there. But yeah, it's about keeping your eyes open and seeing what opportunities are out there.
Well, what? Go ahead, Ian.
No, I was going to say the takeaway is like you got to survive, right? Like, and you kind of alluded to that. Like, if you're going to lose money, you got to make sure you still have enough chips. You know, if you're a casino guy, right, you always got to have a couple chips left. If you're, you know, whatever else you're into, it's like you got to have a few chips left on the table. And it sounds like if you didn't kind of manage your money to say, I'm not going all in on this one house, but I need some war chest behind me so I can continue to live. I think if you live long enough in this space, you're eventually going to find what you're good at, right? Jason started in single family and ended up becoming a lender. I started in single family. I tried the defaulted mortgage stuff, and I was like, this is not for me. Too many lawyers. I'm out, right? And we made our money back, but it wasn't for us, you know? And I think that's too many people just give up. They go all in on one thing, and then they're like, I'm in. And then they're like, this sucks. I'm out. And then they leave, they lose a bunch of money. Real estate's the worst thing, or whatever whatever business it is the worst thing. So,
well, an important and really interesting concept is all of these deals you were talking about are worth significantly more money today than they were. It was just the time frame that you own them. And that's the craziest part of this entire business and investing in assets, because, you know, all those things, I mean, we sold, about 20, all of our rental portfolio, which was about 20 properties, like right at COVID time. And they've like doubled in value since then. Right. And we bought them for prices that you were just talking about. And we kind of, you know, luckily they appreciated enough, but we wanted kind of out of them. But like, that's just how it goes. And if you're in these things long enough, now, obviously the challenging part is always, can you service the debt for them and can you hang on to them? But Ian's been joking around because Ian's got a few hundred rental properties locally, and, you know, he owns, you know, quite an impressive commercial portfolio and self-storage that like, the craziest part is he doesn't want anything to do with these rental properties, but now because he's had them for so darn long, they're performing better than his storage portfolio that's only 5 years old. You know, he's further along in the amortization cycle, and things are starting to get paid off. And his storage portfolio was purchased great, and it's a fine performing asset, but they're not outperforming these assets that have been along for so long. So, you know, so it's kind of like time is on your side with real estate investing. And if you can kind of hold on for dear life, and I know that's like scary to think, and I think a lot of people, including myself, are scared of high leverage on things, but if you kind of have that risk tolerance, it could work out. You know, it really could work out down the road.
Sure. Yeah, 100%. I mean, we're experiencing that as well. And, you know, it's not a get rich quick kind of business, real estate, right? It's, you know, you get rich slow. And, you know, the cash flow, I don't know if in your experience, but, you know, the cash flow is never quite where you want it to be along the way. But, you know, when you do sell it at the end of the rainbow, you know, you do get that nice equity bump. And so I guess it makes it feel like everything was worth it. But that was my experience, certainly with my rental portfolio. I have to say, it's talking about, you know, what you like and don't like, what works for you, what doesn't work for you. I couldn't wait to sell my rental properties, man. When I sold my last one, I think in 2018, it was like one of the best days of my life. You know, it was like, you know, kids and then selling my last rental property.
Me too. Let's talk a little bit about the private money that you've raised over the years, because you've raised a big number. And, you know, obviously you're doing tons of, you know, just by this conversation, you know, I think the audience can tell that you've been involved in a lot of real estate transactions. How are these things funded? Were you getting traditional financing back in the day? Were you raising private money? Like, were you doing joint ventures? How did you kind of put all these deals together?
Sure. So, in my first business, my single family, you know, rental, fix and flip, wholesale business, you know, I was funding that primarily myself, which of course explains why I kind of got blown up, as the market moved against me. But then, you know, from there, when Joe and I started the distressed mortgage debt business, we would put, syndications together. You know, we put groups of investors together, to buy these pools of loans. I mean, initially we started out with our own money. I mean, talk about, you know, keeping a couple bucks on the side. Our first distressed mortgage portfolio that we bought was 6 loans. We bought it for $12,000. So that was in 2010. And then now, like, we're actually out in the market. We're selling a portfolio of loans right now. We're selling 250 loans that I think we're going to be selling for about $3 million. So it's just kind of crazy how things evolve over time. But yeah, in that time, the first few deals we funded ourselves, and then we would go out to investors, that we met along the way, and then we would, present our deals to them, and we would come up with a split and that sort of thing. And then, starting in 2018, we had a big deal that was, kind of one of those life changer deals. And so since then, we've actually been funding the distressed debt business internally. On the storage side of the world, we've been raising capital in equity syndications, go into high net worth, accredited investors, $50,000, $100,000, $250,000 checks at a time. So we've raised $18, $19 million doing that over the past 5 years while we've built our self-storage portfolio. In the distressed debt world, we raised 40 something million in that world. So yeah, we've been out raising some capital. It's been great. It's exciting. We've been able to do that to grow our business, right? We couldn't have grown our business without some of that outside capital. And for the investors that we've done really well for, they've been with us now for years, and they don't even really push back on our deals anymore. They don't really look at them. They just know, hey, Joe and Tom, yeah, they've made us money in the past. So yeah, where do I sign? So it's a kind of a beautiful thing.
Yeah, I mean, that's the best way to be. You got to get to that level, and you got to try it out. I think an important fact that you brought up that a lot of people skip over is like, oh, I'm just going to go out, I'm going to raise money, I'm going to go do a deal. It's like, well, no, you need to do the deal first and then be able to case study and show people. Can you walk us, and we don't really dive a lot into this on our show, can you kind of dive into, like, when you're going to sit down with an investor, like, what that conversation, are you giving them, here's what we've done in the past, here's our expectations, like, what is that, without giving away your whole pitch, but in the end, like, what does that process look like for you guys to build that confidence for someone to invest?
Sure. Yeah. Well, of course, track record is hugely important. And then just coming across as credible. So, it's not just the Tom show or the Tom and Joe show, right? We have a whole team of people. So there's, a business behind us that's doing all the things that you need to do to run the business and protect the capital. So I think that's important. But I think, Ian, what we typically do when we talk to an investor, as much as possible, we try to flip the script on them. In other words, we want to hear from them. Like, what are they looking to accomplish with their investing? What have they invested in the past? What's worked out for them? What hasn't worked out for them? Are they investing for cash flow? Are they investing for growth? Are they investing for capital preservation? Are they looking for tax advantages? So we want to hear from them, those, what they're really looking for. And then just, I guess just the way the brain works is they're explaining to us what they want. It just kind of helps them to feel better about us and what we're doing. And then, we kind of marry that up with our track record. And we also try to add value to our investors in between deals, right? So even though, we might not do a deal for a while, there's that time in between where we're still in touch with our investors. We're educating them what we're seeing in the marketplace, deals we passed on. Oh, they love to hear about that. They love to hear that you're disciplined. You're not just buying everything you can. Deals we passed on is huge. And then, just so when the next deal does come up, they're ready to roll. It's not like we're coming out of left field asking, them to invest. We just present to them the deal, and it matches up with all the cool things that we've taught them and shown them along the way, and they invest.
Yeah, it all makes sense. I was literally typing down a note, deals passed on. Like, what a great content idea, right? Because people only hear from you.
Yeah.
I hate to say it, people only call when they want something. Nobody ever just calls to say hi, right? Like, I think that's a great way to tap the door. I mean, that's actually genius. I'm just sitting here processing it. So
yeah. No, they do. They love that because it shows you're credible, you're disciplined. right? You're, you're not just out there chasing whatever deal you can get your hands on. That's an easy way to go out of business pretty quick.
Well, and it presents more transparency, right? Because people don't see the
That's right.
hours and hours that we all go through underwriting deals. We're purchasing, me and you across the top here, and Jason's lending, right? He still looks at thousands and thousands of deals. Like, it is such a great credibility piece to be like, yeah, we are the experts in this marketplace, and this is why this is the one. And that's it. This is why we are buying this exact one, because you saw all the other crap I passed on. So
that's right.
Smart. So with that being said, so like as you've grown and the ability to raise capital, right? You almost, I think it's over 60 or 70 million bucks if I did my math correctly. How do you continue to deploy, right? Like, you guys as operators can only do so much, and it sounds like you got your business pretty dialed in, because me and my business partner, we've raised 20, 30 million bucks, but there's days where I'm like, I'd rather just find a bunch of operators, that we've like, Jason and I did a pretty cool deal that we case study where, we put money into someone else's deal and the money came back to us and we made money. It's like, oh, that's nice. And we can help that guy out. And how do you deploy that much capital? I'm guessing distressed mortgages probably chew up a lot of capital, but like, how do you continually have places to deploy your capital?
Sure. Well, as I mentioned, you guys, before we hit record today, and I'm actually kind of in a transition period right now. So I've helped build Belrose Storage Group the last 5 years, and I told my partners pretty much when we started the company, like, hey, I'll get the team together, let's get this up and running, we'll get things humming. But I'm gonna eventually want to go and do my own thing, because to your point, Ian, like there's way, there's a lot of deals out there. And there's more to the investing than just self-storage, right? And at the end of the day, I feel like I'm an investor myself, right? So I've invested in other people's deals too, which is great. I've been investing in multifamily since 2013. So I have some trusted operators that I know, like, and trust, and they've delivered for me over the years. And so I'm in this period now where I've just launched a new venture. It's called Eagle Capital Investments. And the mission of Eagle Capital Investments is to basically take the network of trusted operators that I've come to know, like, and trust over the years as an investor in things like multifamily, medical office. I've got a guy doing some cool stuff in the lending space, and it's kind of distressed credit card, kind of space, which is pretty neat. And mobile home park. So, I have these people that I'm investing with personally. So I figure, well, hey, why not go to my investors that I've raised money from over the years and give them the benefit of the work that I've done and the network I've built, so they can invest alongside me in these other opportunities, so they can diversify and get their cash flow going, get their growth going, tax advantage, all that cool stuff. But they can basically piggyback off of my experience and my network. So I'm super excited about it. It's kind of a passion project a little bit. I didn't have to do it, but it was something I felt like I wanted to do at this stage of my career. I'm doing a lot more like mentoring and that sort of thing for young people, business owners, that sort of thing. And so I figured, well, this would be a great way to help investors out there that I've been working with for all these years. Just help them diversify, not just into storage through Belrose Storage Group, but also get into some other asset classes so they can secure their financial future.
Yeah, it makes a lot of sense. And the one thing that we realize, and I'm sure you probably realize as well, is the one thing that a lot of high net worth folks have, and a lot of people that have a lot of capital that they could deploy, is they don't have access to deals. They're not active investors like we all are.
That's right. That's right.
And that was always kind of a way that after I, learned that and ingrained that in my head, that was a way to help raise capital early on. It's, hey, I've got a really good opportunity that, we have access to, and we're going to continue to. And that's a way to build loyal private lenders or capital investors. And, that's what we do full time. A lot of these guys don't. So it's something to think about, but it's gotta be a good deal, right? It's not just like, hey, I got this deal, you want to do it? Like we're not, none of us are brokering deals to people and just trying to like take a fee. Like what hey, you're doing deals with these, investor with these groups anyways. So why not, bring along some of my capital investors as well? And we do that as well. And, we all invest side by side in some of these. Do you have any tips or tricks for, vetting some of these operators that you're potentially trying to do deals with? I know there's a lot of capital out that, they want to be involved in deals like this, but they're not 100% sure, especially if it's outside their core competency, especially asset classes that they might not be familiar with. Like a few tips to kind of vet some of these folks.
Sure. Yeah. And Jason, before I get to that, you made a great point there, which is, there's people out there that are, they're running a business, or they're a doctor or attorney, or, they're doing their thing that makes them their money. So they don't have the time, or maybe even the inclination, or the network or whatever to do what we do. So yeah, I think we're offering a great service to people. But we over the years we've actually developed a methodology that we call the safe system. And investing isn't safe, but if you follow the safe method, you can definitely de-risk these deals that you're looking at as an investor. And it's something that I use. And again, this is one of the tools that I use that my network of investors is able to leverage. But SAFE is an acronym, and S stands for sponsor. So, who are you handing your money over to, right? A lot of people, a lot of investors, especially newer investors, high net worth or otherwise, they might be super smart in their world, but a lot of them skip past this and they go right to A, which is asset. And because they want to hear about the deal. They want to hear, oh, it's a self-storage facility. Oh, it's a multifamily property. But really, you got to take your time and look at the sponsor. And so the way that we do that, Jason, is, first of all, if it's at all possible, we'll get knee to knee with them. We'll travel to visit with them. A lot of the people I do business with, I've met all of them personally at least a handful of times, because that's how you really get to know somebody, see if there's a, kind of a connection. I've met plenty of people. I'm like, hey, they're a really nice guy. They even have a decent track record, but there's just something that just didn't sit right with me. And so I'm going to move on to the next guy. So, there's definitely a little bit of a gut feel action going on there, but you just want to ask a lot of questions. Tell me about your background, tell me about your team, right? If it's just, Joe Capital Raiser at gmail.com, that raises a red flag, right? And what's their track record, what's their background, if you should ask for a background check, like, have they been in trouble with the law? Like, that would have said, if I had just Googled this guy's name years ago when I was investing some money. Now, I literally lost 50 grand because I put money in this guy's fund and it turned out to be a Ponzi scheme. But had I Googled the guy's name, all I had to do is Google the guy's name. Now, in my defense, this was in the 2010, 2011 timeframe. Google wasn't as prevalent as it is now. It's not like it's not on everybody's phones and whatnot back then. But had I done that, I would have seen he had multiple issues over the years, taking money. So those are all important things, and I think just asking a ton of questions. And if at any point a red flag comes up or just something doesn't seem right, just move on to the next guy. There's a lot of operators out there.
Yeah, no, I think that's a really good point. I know I get nervous. We've gotten to a point where we're starting to get the friends of the friends, right? And it's like, hey, I got this guy, and it's like, well, I want to sit down and have a coffee with you. You're handing us money, and I want you to feel comfortable. And I think many people, Jason talks about a lot about this, is too many operators become desperate, right? And they become desperate and they take money from just Joe Blow, right? And it's a two-way street, and I think people forget that. As much as we're vetting the investor, they're vetting us, and you need to have that open line of communication to make sure that everything is proper and that they're a good fit. I mean, there's some investors that we are starting to pace their ability to tolerate some of the deals we're doing, and I get that, right? As new development, it gets harder to make distributions. It's like, okay, well, this is not a right fit for you. Your tolerance isn't there. But you know what? We have another option for you. We can put you in a straight debt type deal or something like that where we can get you consistency. And I think the evolution of the sponsor and the evolution of the investor overall and reading that situation really makes it a a more positive way to run your business. Because the last thing you need is the people who invested with you to not be on your side, right? It's a
That's
full team effort. Even though they are passive, they still need to be your best cheerleaders to make sure you're getting the deal done. So
100%, which is why, when we were talking earlier about our investor process, like it's a funnel process, right? So we attract investors, top of the funnel, but the middle of the funnel is super important. The nurturing and the education, you can't do too much of that. Because too many sponsors, I think they go from attracting a lead through whatever means, LinkedIn, whatever. And then, hey, I got a deal. It's like, that it's like the hot girl at the bar, right? You go up to her, buy her a drink and then, hey, you want to marry me? It doesn't work that way. You got to do the nurturing, got to do the education. And then when the deal does come around, now it kind of gives you the right as the sponsor to say, hey, this is the deal we've been talking about. Let's go. But yeah, you can't do too much nurturing and educating.
Yeah, no, I'm excited to see where I guess people are starting to call it fund to fund model.
Yes.
I think that'd be real interesting to see because, it's like you start to get more looks at more markets and you get to see more opportunities. I think that'll be an interesting thing. It sounds like my one employee is getting beat up out there. So I'm sorry for any background noise. He's had a rough go the past few weeks. But anyway, with that being said, it'll be interesting to see because you get more looks. And the few deals that Jason and I had done together in similar fashion, it's like Jason gets to see what we're doing. Then the right operator comes through. I'm like, hey, Jason, this guy, we can put some money in. Boom, off we go. And now we have a whole new line of business and it starts to become a nice downline and nice silos and you can grow. So I'm definitely excited to see that. Do you have a way that people can apply or are you just going to work with trusted operators for now?
Yeah. So as of right now, I have plenty of operators that I already have come to know, like, and trust. I'm not really looking to add anymore right now. But if I were, maybe I'd add one if it was like a really unique situation. Because I'm trying to help my investors too. Because again, I'm an investor, so I'm trying to help my investors really diversify. And like we talked about earlier, there's more to the world than just self storage. I had a great run with that in the last 5 years. I mean, I'm still an owner of the company, so I'm, in that world, but, multifamily is great. And medical office is really a pretty incredible asset class too. And then there's some other things outside of real estate that I'm starting to take a look at with some guys that I've known for a long time. So, I think it's just important to, keep your eyes open where the opportunities are because they're not always, in self-storage or in multifamily, not always in real estate. Maybe it's adjacent to real estate or something different. So got to keep your eyes open.
I would agree with that. Keep underwriting deals. Too many people just say, oh, this is the only thing I do. And they don't continue to look. I'm not saying to go do a bunch of different things, but you need to keep your eye on the prize and be aware of what's going on in the marketplace. Dude, this has been awesome. I know I got a massive takeaway from this conversation. One thing we like to ask all of our guests is, what's one book or podcast that you think everybody should read or know about?
Well, it's funny you ask that. It's good because as you were talking, it reminded me. I think the first investment book I ever read had to be I think in maybe the late 80s or something. Was One Up on Wall Street by Peter Lynch, who went on to become, one of the most famous, mutual fund managers. But I remember in that book, he just talked about invest in things that invest in things that you understand. And that way, you can see what's going on with the business and make the right decision, investment decision. So, like we were talking about a minute ago, the different assets you can invest in. And that's why I think I gravitate toward real estate is because, when I was in investment banking in the early 2000s, it was, the beginning of the internet. And, we'd be in our office and these companies would come in and pitch us on these deals about, they're doing this website and that website and they're grabbing all these eyeballs and blah, blah, blah. I'm like, okay, that's great. But where's the money? You have to generate revenue. So I seem to be like a dissenting voice in the room because people were all excited, right? And look, there are plenty of people made $1 gazillion investing in the internet, but I just didn't really get it at first. But real estate, I can get my head around, right? Like self-storage, it's a concrete floor, metal box, roll up door, not a whole lot to it. Multifamily, I've lived in an apartment, so I know what that's like.
Yep.
And then, the whole thing with crypto right now, blockchain, it's like, can you explain blockchain to your mom? If not, you probably don't want to invest in it. So anyway, I just take that kind of simple approach, but it all started with that book by Peter Lynch, One Up on Wall Street. And I'll give you one more bonus. Sorry, I'm solidly in my 50s now, so I tend to ramble. But my favorite book of all time is called The Last Place on Earth. And it's not a real estate book. It's not a business book. It's about the race to the South Pole. And it's the Norwegian, hippie dude against the British Royal Navy. And they were racing. And it's such a cool story. But there are many, many, many leadership and business lessons in there. But the whole adventure is just so cool. I love reading that book, once a year or two.
All right, Jason, put it on the list. We'll have to dial that one up. We like to read books together because then we discuss them. And you get deep in the business books, and every once in a while you're like, I need something else. And what do we do? What was that crypto? Not the guy from Silk Road. What was that called? You remember, Jay? The guy's whole story. He's basically a guy not founded Bitcoin, but he built Silk Road. It was actually a pretty good book, cool. And it was good to read something other than
sure.
Wait, wasn't it Silk Road? Is that what you're not talking about?
Was it?
It wasn't the book Silk Road? Is that what you're talking about?
Is that what it was called? I thought it was called something else. Anyway, whatever. Yeah. It was something else. Anyway, enough about us. Tom, where's the best place people can find you on the internet? You've provided us a ton of info. They want to learn more about you. They want to learn how to invest with you and see what you guys got going on. Where can they find you?
Yeah, man. Ian, Jason, it's been a ton of fun. Thank you guys so much. Yeah, so I'm Tom Dunkel. I'm the managing principal at Eagle Capital Investments. You can find us at eaglecapitalinvestments.com. And I kind of alluded to it in our chat earlier, but we do have a free resource there, an ebook that I've written that's available for our investors out there. It's called The Safe Investing Method, and SAFE, sponsor, asset, financials, and exit. And it gives you all the questions to ask when you're going into a deal so you can make a good decision. So you can find me there.
Right on. We'll get that in the show notes. We appreciate you coming on. Guys, as you can see, Tom's just another guy doing deals. Please share the show. It's the best compliment we can give him, and we will catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.